Retire with a stress-free 9% yielding monthly paying dividend portfolio. Retirement is supposed to be a time for hammocks, not heartburn. A peaceful morning with a cup of coffee and the paper, not anxiety over whether your nest egg is about to crack. But in a world of roller coaster markets, inflation that refuses to take a nap, and headlines that scream recession imminent every third Tuesday, how can you retire stress-free? Simple. You build a monthly paying, 9% yielding dividend portfolio that works harder than you do. One that doesn't need your micromanagement. One that pays you like clockwork while you golf, garden, travel, or binge-watch Netflix shows with subtitles pretending it's culture. The psychology of monthly income. Let's be honest. The typical quarterly dividend schedule most stocks use is fine if you're a spreadsheet. But people live monthly. Mortgages, groceries, gas, and even our vices, streaming subscriptions, anyone, come due every 30-ish days. When your income aligns with your life, things get easier. More predictable. Less stressful. That's where monthly dividend payers shine. You don't have to dip into your principal, sell shares at a loss, or wake up at 2 a.m. wondering if your retirement calculator lied to you. You just watch the dividends roll in 12 times a year. But where do you find those juicy, monthly paying, 9% yielding dividend beasts? Let's dig in. Building your 9% monthly paying portfolio, 5 key ingredients. This isn't a fantasy. It's totally doable if you know where to look. The secret is mixing a little risk with a lot of strategy. Here's a high-level model. 1. Covered call ETFs, monthly machines. Covered call ETFs like JEPQ or QYLD are like the chill stoner cousin of tech investing. They live off the volatility of stocks like Apple and Amazon, but without the drama. These funds own high-quality tech stocks and sell call options on them to generate income. Example yield, 10%. Pros, monthly income, solid underlying stocks. Cons, limited upside in bull markets. Add a 20% allocation here and enjoy some of the juiciest monthly checks around. 2. Business development companies, BDCs. Ever wanted to be a loan shark, but legally and ethically? Welcome to BDCs. These companies lend to small and mid-sized businesses, often at high interest rates. Think Main Street Capital, Maine, or ARCC, Ares Capital. Example yield, 8 to 10%. Pros, high yield, monthly payers like Maine. Cons, sensitive to interest rates and credit quality. A 25% slice of BDCs adds a backbone of debt-based income to your portfolio. 3. REITs, real estate investment trusts. Owning real estate without clogged toilets or midnight tenant texts. REITs like Realty Income, or Stag Industrial, Stag, pay reliable monthly dividends and own everything from storage units to shopping centers. Example yield, 4 to 6%, but higher with MREITs like AGNC or NLY. Pros, real asset backing, inflation hedge. Cons, sensitive to interest rate hikes. With a 20% allocation, you're building the foundation of stress-free, rent check-like income. 4. Preferred shares and baby bonds. Preferred stocks are like the older sibling of common stocks, less risky, more refined, and usually more generous. Baby bonds are bite-sized corporate debt that trade on exchanges and often pay monthly or quarterly. Example yield, 6 to 8%. Pros, more stable than common stocks. Cons, less upside. These deserve around 15% of your portfolio. Think of them as the calming lavender-scented candle of your income stream. 5. Closed-end funds, CEFs. CEFs are the uncut gems of the dividend world. Many trade at discounts to NAV, net asset value, and offer yields north of 9%. Some even pay every single month. Funds like PDI, PIMCO Dynamic Income, or RA, Brookfield Real Assets, can be real cash cows. Example yield, 10 to 12%. Pros, high yield, monthly income. Cons, leverage risk, complex structures. Give them a 20% allocation and check your mailbox or brokerage account monthly for love letters from Wall Street. The $500,000 portfolio that pays you $3,750 per month. Let's say you've managed to save $500,000. You're not trying to be the next Warren Buffett. You just want a consistent, reasonably safe income stream. Here's how a balanced version of this strategy could look. Asset type allocation yield income/year income/month. Covered call ETFs $100,000, 20%. 10% $10,000, $833. BDCs $125,000, 25%. 9% $11,250, $937. REITs $100,000, 20%. 8% $8,000, $667. Preferred/baby bonds $75,000, 15%. 7% $5,250, $437. CEFs $100,000, 20%. 11% $11,000, $916. Total income. Annual, $45,500. Monthly, $3,791. And guess what? That's just from dividends. You haven't sold a single share. What about inflation? Great question. High-yielding portfolios do face inflation risk, especially if the underlying holdings don't grow over time. That's why we include some exposure to equity-based income, like covered call ETFs and REITs. Funds with inflation-hedged assets, like floating-rate CEFs. A sprinkling of dividend growth stocks, if you want to tilt the portfolio slightly for long-term growth. In this model, you're not just getting high yield, you're getting diversified high yield. Common myths about high yield. Let's debunk a few myths while we're here. High yield means high risk. Not always. Risk comes from concentration and ignorance, not yield alone. Spread your bets and know what you own. You'll lose your principal. Not if you select quality. Yes, high-yield securities can fluctuate, but they're designed for income, not stock-like capital gains. Monthly payers are gimmicks. Tell that to someone who pays rent monthly and doesn't want to draw down savings. Final thoughts: retire like you mean it. Retirement should feel like a reward, not a roulette table. And a 9% yielding monthly dividend portfolio, crafted smartly, can take a huge mental load off your shoulders. Sure, it's not entirely set it and forget it. You'll need to rebalance occasionally, maybe adjust for macro shifts. But that's light work compared to clocking in every Monday. Here's what you gain. Predictable, consistent income. Monthly cash flow that mirrors your lifestyle. Less reliance on market timing. Peace of mind. And the best part? You don't need a financial PhD or a Wall Street connection to pull it off. Just a little diligence, some common sense, and a healthy disrespect for financial experts who say you have to sell 4% of your portfolio every year while hoping the stock market doesn't eat your face. Forget that. Retire your way, with income that works as hard as you used to. Want help building a custom stress-free portfolio? Or want to see which monthly dividend stocks I'm watching now? Drop a comment or sign up for my newsletter, because financial freedom is too important to leave to chance.